answering your tough financial questions for the past 26 years. It's Allworth's Money Matters with co-hosts Scott Hanson and Pat McClain. Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hanson and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. I'm Scott Hanson.
I'm Pat McClain. Glad
you are here with us this weekend. We've got a great program lined up. Of course, both myself and my co-host here, we're financial advisors, practicing advisors. We've been at this for a long time and come here on the weekends to be your financial advisors on the air and help you make wise choices with your finances. And we did we embarked on a study a few years ago on really, part of it was, what's it take to have a happy retirement?
Yeah, we call it the future framework.
Yeah, but in part of this, when we did this, in doing some of our research, we found that confidence, one's confidence with their finances, is not so much correlated to the amount of money they have,
but
whether or not they have a plan in place
that they're confident with the money they have.
Yeah, so a spending plan, a financial plan, an investment plan, those that have the right kind of plan in place have confidence with their finances. So part of our objective, and the reason we've been doing this program for years, to help our listeners have confidence with their finances. And it is a bizarre time right now.
It is a strange world. Because the economy is most certainly down, but the stock market is hit.
If someone would have said, here's what's going to happen to the stock market, do you think the market would hit new highs?
Well, but Scott, so I think a lot about this. In fact, I had this conversation with my neighbor who actually owns a software company that services small businesses. And 35% of the businesses that they served last year are either closed or not operating. 35%. So I said, what do you mean not? What do you mean? He goes, either they closed permanently or they have no one coming through the door because of two reasons. They can't get product to sell or the government wouldn't allow them to open. Yeah. And you're like, wow. But the market's hit new highs.
Yeah, we got there. So anyway, during the program, we've got, of course, we'll take your calls. And if you'd like to be part of the program, 833-99-WORTH. We record the calls during other times. So if you're listening to this and thinking, I'd like for these guys to answer my question at some point in time, simply call us. There'll be a time scheduled and we'll get you your calls.
You'll get to talk with us.
833-99-WORTH is the number. But then we've also are going to be talking with Andy Stout, our Chief Investment Officer. And I think we'll spend a little bit of time with Andy at the get-go here and then hit some calls later. And, of course, as usual, we'll interject some personal stories with I guess.
Okay.
Maybe we will.
Like if they want to hear them.
But usually if we're interested in the other person's a little antidote or something in their life.
Yes.
Otherwise, we don't.
So we're going to talk to Andy. Andy is our Chief Investment Officer. He works out of our Cincinnati office.
We have 14 offices around the country. But Andy's, out of our Cincinnati office. Andy's been with the team for many years. And so I think someone asked me, well, Scott, what happened to David Shower? David is still part of the organization as our Chief Market Strategist. So anyway, Andy, thanks for taking some time to join us today.
Of course. Happy to be here. Happy to talk about the economy.
Yeah, so Andy, of course, Andy's entire role, and I think it's, sometimes people look at financial advisors and think a financial advisor is some sort of money manager who's going to know where I should be to get me in the right investments when things are going up, and then to be able to get me out before things go down. that's not what most good financial advisors do. So anyway, at Allworth, our philosophy is that people are going to get added benefit, not so much on the investment portfolios, well, that's important, but it's all the financial planning aspects that go around with things. And our investments, we take it very seriously, but rather than leaving our individual advisors to spend time on CNBC all day trying to figure out what's going on in the market, we've got an entire team that does this, and they use the team helps build the portfolios for the advisors.
That's right.
So Andy and his team, they're responsible for monitoring the economy and the markets on an hourly, minute by minute basis.
Scott, I mean, look, if you look at since the beginning of the year, how we actually underweighted stocks before, Andy, you can speak to this, how we underweighted stocks before the market, a little bit before they hit an all-time high, and then we overweighted stocks close to the bottom of the market.
Well, we did a rebalance, which essentially we sold off. That was just because of disciplined approach we had going into this.
And that's what I want Andy to talk about is the disciplined approach.
We have no discipline right now because we're talking over each other. You've been here since the start of the show, and all you've said is hi, and we've been entertained. So, Andy, welcome to Allworth Money Matters today.
So, Andy, can you talk a little bit about the disciplined approach and what you think of the markets? And
well, before that, let's hit what's your opinion on why the markets are hitting new highs?
I think it's really this simple. Markets anticipate the future more than they mourn for the past. We're looking forward. What's happened has happened. We know what's happened. That's done. That doesn't matter anymore. What matters is the future. It's really that simple. I mean, there's some other factors, of course, low interest rates being a very important factor, but that's embedded in the future now as well.
And so what does that mean, low interest rates? Does that mean that equities or stocks are more attractive because interest rates are low, or that corporations can actually operate more efficiently because the cost of borrowing is lower, or is it a combination of the two?
It's both. I mean, if you look at any investment, whether it's a corporation or an investor, the value of any asset, could be a stock or some project a corporation is looking to do, the value of any asset is the present value of those future cash flows. What makes those future cash flows more valuable is when interest rates are lower. So when we have low interest rates, those future earnings, which admittedly are lower than what we expected at this time last year,
yes,
but they're almost just as valuable because interest rates are lower.
So the bar is lower, right? So everything is relative. So while earnings will be lower, they're still relative to what the 10-year Treasury is paying. They're higher. Is that what you just said?
Yeah, basically. So when we look at that, we look at the big picture, obviously, and we take a very long-term view of things. And just a second ago, you were talking about the rebalancing process that we have in place. It's a very disciplined process. So what we did was basically it was on February 20th where we rebalanced back to our neutral because our stock exposure had gotten a little bit overweight. So we rebalanced back to neutral. I mean, there was no magic bullet to this. I don't want to make it sound like we were, trying to time the market, but it did happen to be a day after the market high.
So
we
Andy,
trimmed our equity position then.
Andy, so when you say neutral, if that means if I have a 60% equity portfolio, 40% bond, cash, other instruments, that would be considered neutral. At what point in time, how much overweighted in equities does it need to get before you balance back? 5%, 10%?
We'll typically look around 5 percentage points, and that's what we did on March 23rd. So on the other end of the spectrum, obviously the stock market sold off very quickly, had a bear market in record time. A 60-40 portfolio that was rebalanced on February 20th. By March 23rd, which was 4 days after the bottom, is when we rebalanced our 60-40 portfolios again. At that point, it was about 55% stocks, 45% bonds. So it naturally became underweight. And at that point, we said, hey, let's kick this back up to neutral. Happened to be 4 days after the bottom. Again, not trying to time the market. It's just part of our disciplined investment process. But it ended up being a very good decision in hindsight to rebalance at that time.
Well, the decision had been made prior to this, right?
Exactly.
The decision on the investment process was made prior to the pandemic. So when
you weren't responding to market conditions.
Well, we weren't making decisions based upon market decisions.
Okay.
We're making the decision that had already been made ahead of time, which I think is important for any investor, whether they believe in our investment philosophy or have their own. But it's having that. What is the investment approach? What is your investment philosophy? And and don't deviate from that, right?
So Scott,
here's the way to think about it. You want to be proactive, not reactive, and that's what we are here.
And you have to follow the discipline, because I was talking to an investment advisor and he was telling me about all his discipline about how he did it. And then I said, well, what did you do in this circumstance? And he said, well, I didn't do it that time because the market was different.
Okay.
And I said to him, well, you don't have a discipline then, because you've written it down, you thought about it, but when it came to act on it, you did not act on it, which is the same thing as not. It's like me joining the gym and never going. I mean, joining the gym was the easy part. Going is the hard part.
Well, they're closed anyway, so you can't.
Okay. Well, that's it's a metaphor.
Okay. So, Andy, it's what I find interesting. It seems like there's a handful of big companies that are carrying the market to new highs, and there's lots of companies that are still suffering. And as you put the statement of markets anticipate the future more than they mourn the past, but there's a lot of good quality companies that the stock prices are still much lower. So it doesn't. I mean, what's up with this market?
Well, when we look at the companies that have done the best, it's really the ones that are positioned to weather the work from home experience. So what you and I are doing, we've been having a lot of calls on Zoom, as an example. In Google, Apple, they're able to really leverage the situation better than your brick and mortar stores like Macy's, obviously, and Amazon, obviously, is doing a great job. So what you're seeing is these companies that are, I'll say, more in the cloud, if you will, not from a valuation perspective, although an argument can be made there, but more from like an internet presence. They are being utilized more by consumers today, and that's helping their future earnings. Now, if we look at from a valuation perspective, these few companies that have kind of lifted the entire your portfolio kind of in aggregate, they are a little bit stretched. So, I mean, that's a good reason to want to make sure that when I say stretch, I'm talking about like how much earnings they have for a dollar of whatever their price of the stock is. You want to make sure you have an overall balanced portfolio. So these stocks will eventually come back down to earth to be a little bit more reasonable. But we're not going to try to pick the exact time that happens. But by having a broad-based asset allocated approach, you get exposures to all of those good stocks as well. So even when there is the inevitable rotation out of those stocks, I'm not saying it's going to happen yet, but you're going to have exposure to the other areas that are going to benefit in the meantime.
So, Andy, when we talk about stretch, we're talking about price to earnings, right? So if a company is trading at 20 times earnings for every dollar it makes, it trades for $20. When you say stretched, what do you mean by how are they stretched? So is it 50 times earnings? Is it 100 times earnings? Because 22% of the S&P 500 is now made up of less than 10 stocks, right? 22%, right? So how stretched are they?
Well, when we look at it in a few different ways, we can look at the trailing earnings or the forward earnings. But either way that you look at them, when we're talking about stretch, we can talk about the PE ratio. You're looking right around that 20 to 21 level when we're looking at forward earnings. So that's higher than normal. The normal level is usually around an 18 forward price to earnings ratio. So we are a little bit elevated there on the forward basis.
When you look at it that way,
higher. It's not 25, 26.
But it's when you look at it in relation to the low interest rates,
the bond,
it maybe is not that high, right?
Right.
Exactly. So if you're an investor, think about this. You have two choices. You can invest in stocks or you can invest in bonds. Let's just keep it that simple. I know there's other things you can do. Your bond return is typically going to be whatever your interest rate is over that period of time. Right now, bond interest rates, so for long-term investor, you might be getting about 2%. I know it kind of stinks, but that's just where interest rate levels are. The levels are the levels. You can't change that. When you think about a stock investor, you have where you've been talking the PE ratio. So let's just say the price earnings ratio is 20. If you take the inverse of that, meaning you flip it upside down, you get what's called earnings yield. That's at 4%. So if you look at it from a very simple perspective of, and this doesn't include dividends for stocks, but maybe we're getting a higher expected return on the stocks with that 4% level. Again, not a long-term prediction, but it's higher than that 2% on bonds. So if you have two choices, stocks or bonds, right now stocks technically are a little bit more attractive looking at just price earnings. But I'll tell you what, Scott and Pat, we look at a lot more than just the PE ratio. I mean, there's a lot of other valuation techniques. So when we're looking at other ways to value stocks, they're not as overvalued as just the price to earnings ratio may look at it. Now, some of these tech companies, they are overvalued in other areas like the price to cash flow, price to sales, but really outside of that area, the rest of the market isn't really overvalued from a historical basis.
By the way, this is Allworth's Money Matters here with Andy Stout, Chief Investment Officer. But so I don't think we've seen the same kind of run-ups like in the European markets.
Yeah, why
and their
is
interest
that?
rates are even lower.
Yeah, why is
negative
that?
in many cases.
Do you have an opinion about that? Do you have an opinion about that? Not why is that? Because I know you don't actually know the answer.
Well, I mean, let's think about the companies in Europe. I mean, if you look at like the top companies in Europe, the top companies in the U.S., there's not anything that really inspires you.
They're all old line companies,
like Nestle,
exactly.
Or
Siemens,
a lot of
right?
It's
Mercedes.
dominated by banks. They're a big company. The banks take up a big amount, and banks are struggling because of interest rates being so low. And, they're not able to make a good profit there. So there's an impact there in Europe as far as that goes. Now, when we look at the demographics in Europe, they're not as good at either. But if you just look at a long history of the earnings growth in Europe versus the U.S., earnings growth in Europe's been all over the place. They're getting hammered by one crisis after the next. We had Brexit, obviously still going on, but over the past couple of years prior to that, you had the European debt crisis where you had Portugal, Italy, Greece, and Spain. You thought they might fall out of the European Union, thought they were going to default on their debt. So they've had a crisis after crisis after crisis. And that's why we haven't really seen any long-term growth out of Europe. Now, that will change as well. From a valuation perspective, we're talking about valuations. Europe is relatively attractive compared to its own history. So, there could be some upside there. But in the meantime, still focusing here on the U.S., we still like U.S. stocks better than European stocks.
And so we had the what was the CARES Act, or I can't keep track.
The HEROES Act, the Cure Act.
Well, okay, whatever.
Always really
anyway, the big stimulus.
That was the CARES Act.
And then Congress, people were expecting them to come up with something. They didn't.
What's the effect of that?
So we hit new high. So one would expect that we're going to struggle hitting new highs without
the government giving everyone more money.
Well, yeah, right. But
the market's expecting the Congress to eventually do something. I know President Trump basically he signed 4 executive orders a couple of weekends ago. One of them was $400 in unemployment benefits. $300 that was from the federal government, $100 from the states. Although it sounds like a lot of states aren't even going to kick in that extra $100. So if people who are unemployed are looking closer at $300 as far as that goes. But it's also it's redirecting current funds. It's actually not new money. President Trump doesn't have the authority to do that. He's just redirecting, at least on the federal level, stuff from the coronavirus relief fund. So that's where, or the disaster relief fund, that's where the federal money is actually kicking in from. So he's not creating new money. We're still going to need Congress to come together. Most people think they will. They probably will, just because they don't want to get blamed for, things getting worse. But you know what? They're in recess right now. So I think the Senate's out till September 8th unless they want to come back before Labor Day.
And so talk a little bit, if you would. I'm interested what you think about the airlines and the hospitality industry, specifically hotels and the travel industry. In your opinion, what will the recovery look like? Will it ever get back to where it was? Is it going to be 50%? What are your thoughts on that, Andy?
Or what's the market pricing in?
Oh yeah, what's the market say?
Well, obviously, these industries have just gotten decimated in the stock market, and that's no secret, and it's no surprise. And it's going to be a long, slow recovery. When we look at, just going to give you one way to think about it. the total spending by consumers is actually back up to pre-crisis levels, which is kind of mind-boggling to think about considering we completely shut down. But our total spending is back to pre-crisis levels, but we're not spending in the same areas. It's that
That's
hospitality.
amazing.
That is amazing. So the average American is spending as much money now as pre-crisis, but they can't go out to dinner. They can't travel.
Exactly.
So
Exactly.
there is just tons and tons of money being spent on dress shorts and gym shorts for Zoom meetings. Right.
Home projects.
And when we think long term about the hospitality industry, well, it's going to take a long time to fully recover. I mean, just look at airline passengers. In early March, before the shutdown, we were seeing about 2 million passengers on the airline side. Now we're looking at about 700,000, and that's a recovery.
When you say 2 million a day, 2 million a month, 2 million, when you say 2 million?
Basically, it's over like a 1 week period.
Okay.
So like the week ending March 6th, I think it was around 2 million. The week ending August 14th, it was around 700,000. So it's a big drop off. And in April, it was around 95,000. So a pretty big drop in airline. We have seen a good recovery, obviously 95,000, 700,000. But airline industries, they're not flying as much. There's obviously lots of layoffs. American Airlines, they're going to stop flights in 15 cities once the government aid ends. So it's going to take a while for these to get really back to where they once were. And going out to restaurants, I mean, restaurant bookings were down 54% compared to the same time last year. Now, clearly it's better than where we were in April and May when you weren't allowed to go out to eat. But what we've seen,
Andy,
though,
can
in
you,
the data,
for a second, can I ask you this?
off too.
Andy, how do you know that statistic off the top of your head?
So here's what I was waiting for the opportunity to state. There was a list of questions for us to ask Andy. I don't know if we've asked any of them. We're just asking random questions that we're interested in, and he's spitting out these.
How did you know this 54%? How do you know that?
I just look at the data every day. I mean, it's part of my daily routine. I have some screens in front of me that I know what
How
I'm
many
looking
screens
at.
do you have in front of you?
Well, a lot.
Like
well, I mean, 2 screens, but there's a lot of
monitors,
windows where I can.
Okay. Anyway,
I just go through lots of data.
so we have a ton of questions that we're going to now ask you.
But all right. It appears to me that the typical investor is saying, this is all going to be short-lived. Not really that concerned about what's going to happen between now and the end of the year. I'm looking at 21, 22, 25, 20, right? It feels like the market must be pricing in a vaccine
Or
at some
some
point,
therapeutic.
or some therapeutic that's going to allow the economy to open up again.
Is it?
Right. Yeah. I mean, so right now, if we look at the medical side of things, first, the therapeutics. Well, there's 2 decent therapeutics out there, right? There's remdesivir and dexamethasone. The issue with them is the supply chain logistics, making sure they're able to get out to enough people. But fortunately, we have seen the new daily cases come down over the past few weeks. The 7-day moving average here in the U.S. of new cases is basically back to where it was at the beginning of July. And we're right around 47,000 on a daily average if you look at the past 7 days. Now, on the vaccine side of things, we all know, or maybe we don't all know, but Russia registered the first vaccine last Wednesday. It's met with a lot of skepticism in the scientific community.
I doubt Putin's taking the vaccine. I'm just saying.
Well, he said his daughter's taking it though. So although apparently it's just a strange dog.
Sure. He's wrestling a bear
so.
right now. He would take the vaccine, but he's wrestling a bear.
Yeah, but let's put aside the Russian vaccine for now, just because it really hasn't been through as many trials as a lot of the other ones. We have 6 vaccines that's in phase 3 trials. What that means, there's testing on several thousands of people. So that's actually really good. Things have been sped up from that perspective. The issue becomes, there's a couple issues, but one, we probably will have a vaccine sometime in the fourth quarter that will be made available to medical personnel and those high at risk from one of those six, or if not more of the six. They do use different ways to come up with their vaccine in order to fight off the virus. So there's actually a lot of good progress on the vaccine front. The concern I have is a lot of people aren't going to want to take it. There was a survey done by Gallup just a few weeks ago that showed that 35% of Americans would be unwilling to take a free FDA-approved vaccine.
Yeah.
Well, that's a big number. And
it's an interesting time
because they're worried about the long-term effects.
Yes. Yeah. So,
Andy, appreciate as always.
Every time I talk to the guy, I'm actually I'm astounded, Scott, that he actually he knows these. And we didn't say these are the list of questions we're going to ask you.
Yeah. Anyway, Andy, thanks again for being part of the program today, and thanks for all you do for Allworth and the clients that we serve.
Absolutely. Always happy to talk the economy.
All right. Thanks. I know he does quite a bit too, so he obviously loves and breathes the stuff. What's so nice about having Andy Stout as part of our team, communicate with the advisors on a regular basis, making sure that
building portfolios,
our financial plans are designed to weather whatever the next storm might be that comes. We're going to take a quick break. When we come back, we'll take some calls. You're listening to Allworth's Money Matters.
Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
Welcome back to Allworth's Money Matters. Scott Hansen.
Pat McClain.
Thanks for joining us, being part of our program today. Our number to be on the show, if you got a question for us, 833-99-WORTH is the number, 833-99-WORTH. And let's talk with Maggie. Maggie, you're with Allworth's Money Matters.
Good morning, guys. How you doing?
We're wonderful. Thank you, Maggie. Thanks for joining us.
Okay, I have some questions. I had to retire last year unexpectedly due to an illness.
Sorry to hear that. Was that your illness or someone in your life?
Yeah, it's my illness, darn it.
Sorry.
But I'm dealing with it. Anyway, I'll be 68 next month. And I have about $400,000 in an IRA, and then I have about $100,000 in a 401k, and then about $40,000 in a different 401k from different employers. Now, my husband is 68. He retired 18 years ago, and he has about 200. I know was not my idea. Anyway, yeah, I know. Anyway, he has about $200,000 left in his IRA. So at this point, I'm wondering about a lot of things, but one thing to keep in mind is I may move to a different state depending on how the election goes, along with half of the other people in California. However, I'm wondering, should I be converting some of my 401ks or some of my IRA to Roth to protect from future taxes?
When do you think you might leave California?
Depending on how the election goes, possibly next year.
And are you on Social Security, and is your husband on Social Security right now?
Yes.
You're
We're both on Social Security, and he's taking a distribution from his IRA. So our income is about $70,000 a year now.
And how big is his distribution every year from his IRA?
He's taking, I believe, $27,000 a year.
Okay, so he's taking 13.5% out of that.
Wait,
so he knows he's drawing it down.
What's your home?
When he started it, his IRA was like $480. So I mean, it was a legal percentage when he started.
Understand.
Although it was high. I mean, it was like whatever the highest was back 18 years ago.
Oh, because he
or-
did it under 72T, which is a substantially equal
Exactly.
distribution prior to age 59 and a half. But he can change it at any time, by the way. But that's a different subject altogether.
Yeah,
Well-
that is a different subject. Now, back to what you were asking. Our home we owe about $290 on our home. It's worth about $630. I talked to our tax person. She said we have about 30,000 cush before we go into a higher tax bracket. So I could either convert some of my 401ks or my IRAs to a Roth.
And what do you
Or-
have as far as cash outside of retirement plans?
Not much. That was another thing. I thought maybe I should just take like 20,000 out and keep it in CDs for emergency use or something.
Well, it doesn't. That wouldn't be a driver because you could keep it in CDs inside the IRA and not pay taxes.
And do you have adult children, grandchildren that live near you now?
I have one adult child that lives with me who has a disability,
Oh,
Nope.
and yeah.
But do you have like grandchildren that live is there a reason you're living in California other than the fact that you're living in California? Is there some emotional family connection that's keeping you here?
I have two sons. I have two sons in California. One is about 3 hours away, and one lives with me.
I mean, because from a financial standpoint, I mean, it's there's not a ton. What was your pay before you were forced to retire, Maggie?
I had a really good job years ago. They downsized it, sent it out of state. So the last job I had was about $38,000, but it was just a temporary job.
And how much is your Social Security?
Mine is about $1,700.
So, but Scott, between the two of them,
I mean,
they're
part
receiving $43,000 a year in Social Security between the two of them. Just based on
I'm thinking to myself, if you're my older sister, I would say,
Yeah.
if you move to a different state, you could have a house that's paid for. Because part of the concern is your husband's IRA is not going to last forever at $27,000 a year withdrawal and a $200,000 IRA.
But Scott, to counter that, they have $740,000 in IRAs between the two of them. They're taking $27,000 a year out.
You're not touching yours at all yet, Maggie?
I am not touching mine, and like I said, I have $400,000 in an IRA and then $140 in two 401ks.
So you're at a
And I'm not touching
4%.
any of them at this
You're
point.
less than a 4% distribution across all your retirement plans. So
Okay.
if you were my older sister, the first thing I would do.
Well, I used to say if you were my mom because that was much younger then, but now I'm
She's
getting older.
actually could
Before
be.
long, it's going to be if you were my daughter.
So, but no, the first thing, if you were sitting in my office, the first thing I would address is the child that lives with you because of a disability. And I would look to see whether you needed a special needs trust.
Have you
That's
looked into that?
That's the first thing I would do above anything
Actually,
else.
That is a really good point. I did ask someone about that about 2 or 3 years ago, but I never really got any information on how you do that.
Okay. So
Because
that,
my whole point of not touching my 401ks and my IRAs are I am trying to preserve a lot of money in those so they can be inherited by my children.
all right. Well, so, and presumably your disabled child is on Social Security disability.
No, no. It's just a dependent.
Is the child disabled? Is the
In
child
some ways,
unable
yes.
to work for whatever reason? So if you were sitting in my office, that's the first thing we'd talk about, right? Which is because that is the biggest consideration in this financial plan, which is, listen, if your child is dependent upon you because for whatever reason they are unable to be employed or take care of themselves, and you believe that it's your responsibility to do so, not judging whether it is or it isn't, this is the conversation we would have, is, okay, well, then we're going to plan for that, right? If it's not your responsibility, I would do one of two things. I would either consider moving out of state if that is a consideration, because you could actually move out of state, get rid of your mortgage completely, buy a nice house in Idaho, Wyoming, Nevada, Arizona, Colorado.
I was thinking of Idaho, Wyoming.
Well,
Those were my top
everyone
two.
is.
Yeah.
Actually, a friend of mine just moved to Idaho last week.
It's all California. Moving
Just,
to Idaho.
he's like, so actually the problem with moving to Idaho is it will be California soon if enough people move there. I would consider the movement. I would not consider a Roth IRA
No, and think about this.
conversion until
So with right now, you're in a 12% federal income tax bracket, which would bump to 22% when your income, your accountant said you get about a $30,000 room there. That 12% number used to be 15% before the latest. So there's a chance taxes will go up, yes, at some time in the future. But in California, the way the California rate is, it's highly progressive. So it starts at 1%, but at your income level, it's about a 6, maybe an 8% rate in California. So you take that $30,000 out or some portion of it, you're like, yeah, this is great. I get to pay a low tax to the feds, but you're paying all these dollars to the California, which you may not ever, even if you stayed in California, because you'd be pushing yourself up into a higher income.
So the point being is,
conversion.
I like that the fact that you're having the conversation with yourself about should I convert to a Roth or take money out, and the answer is if you think you're going to move to a lower tax state, the answer is no. I would wait. If next year you land on the fact that you're going to live in California forever, then we would have that conversation. I doubt if it ever makes sense for you to actually convert to a Roth IRA. Especially if your goal
Even
is
if you
to
knew you were
leave
going to
these-
stay here, I don't think.
Yeah, especially if your goal is to leave money to the child. But like I said, if the first thing you need to do, you and your husband have to sit down and actually consider.
Well, there are many issues to be dealt with, frankly.
But Scott, the one that would concern me the most if I was
Yes.
Maggie, which would
But
be,
I mean, part of it, as I'm thinking, I'm not trying to like pitch right here, but we call our 7 personal decision point process that as people moving into retirement, one of those 7s, these are the 7 areas that you need to really focus on, and particularly the first year or 2 into retirement. Some immediately, some you got some time. One of those 7s is the estate planning issue. In Maggie's situation, that is a higher priority than maybe some others because of if something happened to both you and your husband today, like
what happens, right?
Well, I have your book, and I do have an estate plan, which I just updated. So I just updated it within the last month.
Beautiful,
because I had done it like 16 years ago,
and it's set up in such a way that you're totally comfortable and
that money
confident.
would be set aside. So in that estate plan, does it set up a special needs trust for your adult child?
It might not need to be a special needs stuff, but have some restrictions on it and doles out the money when needed. Is that kind of how it's set
right?
up?
If something happens to both of us, then my 2 sons are 50-50 on it, and my one son is named as a trustee now. So if my husband and I got in a car accident, and
you're
that son will be able to just take over.
You would be totally fine with both of your children to receive half of your estate day one when you passed away. They've got
absolutely
okay. Well, there we go then.
All right. So the answer to your question, we went on a big journey there, but the answer to your question is no. You should not consider a Roth conversion, nor should you consider taking more money out of that. Probably ever a Roth conversion if you live in the state of California. If you move to another state, you might consider it, but I don't know. There wouldn't be a lot of benefit for you one way or the other.
No, if she was in a zero cost state, I'd certainly The challenge is you don't have.
But why? She's in a zero cost state
because she's in a 12% federal income tax.
But she'll
bracket.
always be in a 12%.
It used to be 15, and it's not
so
a
you're
permanent.
saying if it goes up,
when it sunsets,
what happens if it goes down?
Do you think taxes are going to go down for
They
middle class
did.
Americans?
They went from 15 to 12. I doubt they're going to go any lower. But yes, you would consider that. I stand corrected, Scott.
I mean,
and actually, I have enough income at this time coming in monthly that I'm putting like an extra $300 on my house payment every month.
Don't do that. Don't do that.
No?
No.
Oh, don't do that?
No, no. You want to look, if you're going to stay in this house forever, you want to get the longest mortgage possible.
Gotcha. Okay.
right? And to keep your payments as low as possible if you're going to stay in that house. Because the reality is you owe
And regardless-
$290,000 on it. Putting an extra $300 a month on this thing isn't going to pay. It's never going to be paid off in your lifetime.
It might be when
No,
she's 89.
absolutely not.
She's 68 now.
I know.
It's-
That's what I'm saying.
I don't think so, guys. No, I don't think so.
I wouldn't pay anything extra. In fact, if you're going to stay in that house, I would refinance into a 30-year fixed rate mortgage, the lowest interest rate possible, and not worry
I
about
just
paying
did
it off.
that.
Beautiful.
I just did that in February.
Okay, don't pay
Good.
anything
Well, you're
extra.
doing good.
And if you
Good
want to
for you.
move. If you don't want to move, stay where you're at. You're doing fine.
Yeah.
Okay.
All right, proceed.
Well, I appreciate going on a journey with you guys since I can't go anywhere in real life. And it's too smoky outside to even breathe. So it was nice to take a little virtual journey.
Good.
All
Thanks,
right,
Maggie.
thanks,
Glad you joined the program today. And by the way, our advisors, we've got 80 plus advisors, and meet with people every day on a video call or some phone calls, but typically a video call. It is a weird time when you can't.
Yeah.
Lots of video calls. Anyway, to join Allworth's Money Matters, 833-99-WORTH is the number. It's 833-99-WORTH.
So, Scott, for the listeners, so Maggie called from the Sacramento area. We are broadcasting from the Sacramento area.
And I've lived in the Sacramento area for 30 years, grew up in Southern California, and have been here for...
But there are fires in Northern California. Our studio smells like I'm camping. I mean, it smells like smoke. It is.
I know. And we've got these big air conditioning units and stuff. They're supposed
So
to-
when Maggie said that,
at least there's power on
smoking.
today.
Actually, yesterday I was thinking, I read this book when I was in high school called The Late Great State of California.
That was in high school. That was a long time ago.
Yeah, I read this
It's been
book
pretty good since then.
Well, this story was science fiction about how the
I was talking to someone that's like, "Man, it can't get any worse. Now we got first the pandemic, now the fires or smoke." I said, I said there could be a nice big earthquake in California. They've been predicting that for years.
it could get worse.
And maybe then the locust will come.
Yeah, it could get worse.
All right, 833-99-WORTH. Let's talk with Gary. Gary, you're with Allworth's Money Matters.
Scott and Pat, thank you for taking my call, and of course for all the great financial advice you've provided me over the last 25 years. Long time listener.
Well, thank you.
Oh, good, thanks.
I like the fact that you use the word all rather than some. So,
Let me give you some background here. I'm going to be retiring next June from my second career in education as a public school administrator. I have accrued about 7 years of service with STRS, and it will come out with a monthly modified benefit amount about $1,200 per month. I have the opportunity actually to buy back an additional 3 years of service at a cost of $63,000, which would increase my monthly modified benefit to $1,750, or an increase of about $540 per month. Now, my question is...
How old are you?
I am 63 years of age.
how's your health?
My health is great, and my wife's health is great as well.
How old's your wife?
She's 60 years young.
Got it. So you're 63, she's 60. So we're talking about buying an immediate annuity. And when you say $540 a month, is that a joint and survivor benefit to 100%? Is that what we're talking about? So that if you die...
Yeah, if I die, she will continue to receive that till the day she dies.
And then what is your question for us?
My question is, would it be in my best financial interest to buy back those years?
Let me just
at
put it this
that
way.
Cost?
If you choose not to do it, I'm happy to drive over to your house, give you the check for $63,000 as long as you sign over the rights to that additional income. I'll take
Forever.
this bet all day long.
But
Okay.
now I'm going to ask a couple questions to qualify that because I agree with Scott. Do you have the $63,000 somewhere?
That's a good question.
That's
To
a
buy
good
this with.
question. I do. I have it in a 457
Perfect.
or a 401k, so I would just roll it right over.
And how much do you have in those retirement accounts total?
Well, right now there's about 120,000. I do have about 100,000 in cash.
Okay.
I also have a PERS retirement of well over 90,000 a year. My wife has PERS at 25
Okay.
a year as well too. So
And your house is paid for.
no, it's not.
What do you owe on your home?
I owe just under 300.
All right, but you can afford the payments easily on your pension.
Oh, absolutely. Yeah.
So,
no
you know,
problem at all.
I would not use my 401k and 457 to buy it back. I'd use the cash.
Okay.
And let me tell you why I would use the cash.
Okay.
By using the cash, you're actually kind of converting this into a tax-deferred account because they will allow you to actually use the cash to buy this $63,000. So this extra $540 a month that comes to you, a portion of it will come to you tax-free and a portion of it will become taxable. You're essentially growing that $63,000 tax-free over your remaining and your wife's remaining lifetime. And that's why I would use the cash.
By the way, I ran the numbers.
And I'm going to guess, Scott, what was the return on the money?
It was 10.1% based upon 63. Here's what I did: that $63,000. I assumed a 25-year life expectancy, which is probably actually the statistics are. One of you will clearly pass that. You would need to earn a slightly over 10% return to generate $540 per month.
Gary, this is an IQ test.
I don't know why Cal Sturz is underfunded.
Why
That is it's so strange. Why is it? Why are the government pensions underfunded?
This is crazy. That's why you would drive, Gary.
Before I even ran the numbers, I just looked at it in my head. That looks pretty dang good to me.
That's a crazy return. You would take every penny you have and mortgage your house to buy that pension.
Yeah, of course you would.
Every penny.
Okay.
If I actually had access to a pension like that with all my clients' money, I would close my business down tomorrow and buy every bit of it.
Well, if you remember years ago in the state of California, any state of California employee could buy up to 5 years of additional credit. It was equivalent to about an 8% return. Every client that we had throughout Allworth that was state of California employees that had this option, and some retired, we're like, you have to take your money from here and invest it there because...
Assuming you had a normal life expectancy.
Yeah, because it was 8% plus the cost of living adjustment.
So, yes,
Sure,
you're going to
doesn't
buy
have
it. You're going to use after-tax dollars, that money you have sitting in cash. That's what you're going to use to buy it with.
Okay, very good. And by the way, I am a client of yours, and I did buy back 5 years.
Oh, you did? Okay.
A few years ago. So thank you.
You know what I love? So these conversations are always bittersweet because I'm always so happy to help people whenever we can assist to maximize whatever financial benefits are in their life.
It doesn't matter.
As a taxpayer, it drives me crazy when I look at stuff like this.
Gary, who's your advisor?
Davis is my advisor.
Oh, Davis Bloomquist, very, very sharp
Yes.
young man. Very, very sharp.
Yeah,
young
appreciate.
man.
Glad you called, Gary.
Glad you called,
Wish
and
you well.
appreciate you being a client. And by the way, for full disclosure, Gary's experience may.
It's totally not indicative of other clients. Most clients probably hate us.
Okay, what's the disclosure?
We can't use any sort of testimonial, so we always have to be careful. So when someone says,
We didn't solicit that. We didn't know.
I don't
he
know
was
if
a
he gave
client.
us. He says I've been a client. I don't think he says
He
he's
didn't
had a
say
great
anything
experience.
positive.
We said we helped him with this pension buyback, which is
He may be quite miserable.
yeah, and his investment returns might have been absolutely dismal. As a
Well, I'm
client.
hoping not, but just because
Yeah.
of the regulatory environment we live in, your experience may not be as stupendous as Gary's.
Now, I just ran the numbers based upon the numbers that he provided, which may or may not have been the exact numbers, but
they're pretty darn
I mean,
close.
and we wonder why our government pension plans are.
We don't.
Not, okay, thank you. We don't. Wonder.
Do you wonder?
No, of course I don't. Wonder. I
Do
know
you
exactly
really ever
why.
wonder?
No, you're right. I didn't.
I was actually bike riding a couple days ago with a friend of mine who retired from the state of California as a prison guard. And actually, he was administration in the correction system. And he's like, oh, man, I had no idea when I started this job that I'd be able to retire at 53 with a big old fat pension like this.
I think he needed a job.
He goes, I feel like I hit the lottery.
That's what he
told
said?
me. Oh, yeah. He's like, I would have done it without the pension, but he goes like, you know? I mean, this guy's 100% serious. He did.
Oh, and his pension's probably his income now is probably more than he was
Scott,
making.
You gotta love this guy. So he retired. He went back to work for the state of California half-time. Goes back to work for the state of California half-time. And they said they laid him off because of the pandemic. And they said, well, don't worry about it. You can file for unemployment insurance. And he said to them, don't you think I've gotten enough from the state of California? I'm not going to apply for unemployment insurance. He goes, I just can't. I go, well, that's like a lot of money. He goes, Pat, I just can't.
You're kidding.
No, I'm not kidding. I love the guy. I'm like, that is a stand-up guy. He's like, I've gotten enough from the taxpayer. I'm not going to go to the well anymore. Like, good for you.
It's interesting. Prior to this pandemic, there was already some kind of envy between
pension envy.
Yes, pension envy of people retired with a pension and people didn't retire without a pension. And almost exclusively, the only ones that have pensions anymore are government employees.
Utilities, too.
Okay, so I said almost.
Almost.
Well,
okay.
So the highly regulated by the government industries.
Okay, that's right.
Utilities are just one step away, are they not? I mean, the government tells them what they can charge. The government controls everything about them. A little bit less now than maybe in the past, but and it'll be interesting to see
where this shakes out.
Because there's so many of these cities and states and governments, all the local governments they're struggling so bad right now, and they say we need a federal government bailout, and there may be to some extent, but
when the federal government is looking at the states and saying, look, you're not all the same. Some of you have been fiscally conservative, and some of you have not.
You got like Illinois, Chicago, where they've got people are leaving in droves. I mean, the population in Chicago is shrinking.
You have states like Nevada,
and they're the worst as far as pension,
right?
funding.
In terms of but you've got states like Nevada that don't have nearly as rich of pensions as states like Illinois.
That's right.
Or California.
You're right. The pensions aren't this.
They're not nearly as rich. But the federal government, everyone's got their hand out. And the federal government's like...
And California is now, someone threw out two different things. One is an additional 3% tax on wealthy. So now we're talking over 16% tax.
Okay.
And a wealth tax that they're going to get you even for the next decade once you leave the state. That's what they're proposing right now.
Yeah.
And they wonder why people...
Anyway.
Are leaving. Anyway, we are running out of time, unfortunately, but it's always great having you here. Want to let if you don't receive our newsletter on Fridays, go to allworthfinancial.com and sign up for it, because I think there's some useful information there. We talk about a variety of different things. Andy Stout, who was on earlier, he writes, I think, on a monthly basis for that. We also have a great online learning library. I forget what it's called, but if you kind of search for it, that it's just what do we call that?
Personal learning? I don't know what it's called.
Well, we keep hearing it's good. So, I mean, we do. I get unsolicited feedback. It's like, hey, this has been great. Anyway, we're out of time. Enjoy the rest of your weekend or whatever day it is you're listening to the podcast. And we'll see you next time. This is Scott Hansen, Pat McLean, Allworth Financial.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.